coronavirus and everything else and really just see it as the end of the world, or to see it as the craziest thing ever, or to see it as something that's just never, ever happened before in the history of all mankind. And that's just not the case. There are some common factors that occur all throughout time when it comes to things like this. And I'm going to address some of that. Now, as you get started, those of you who are in the chat, I will answer the questions in the chat before I answer anybody. There are people on the outside there watching via live stream, and you guys can listen in, but I'm going to answer questions in the chat first and foremost. And then also I have questions that some of you submitted, some of the students in the Black Business School submitted in advance, and I will answer every single question that we got in advance. So before we get started, let me just do one little housekeeping thing, and we can get it cracking. Put your question in the, don't put your question in the chat though. If you have a question, put it in the Q&A section. So if you're in the webinar, put your question in the Q&A section, and that way I'll see it. Also, give me a yes or no if you can hear me and see me. If you can hear me and you can see me, give me a yes or a no. So give me 1 second. I'm going to invite some more students in, and we're going to get started here. Okay. All right. So here's what here's what's really kind of happening, as it pertains to the coronavirus and everything that people are saying. I mean, it's all over the news right now. Have you guys been following this? Have you guys been following what's happening with the coronavirus? I assume you've been following some of it. Give me a yes or no. How many of you have been following the financial conversations? Have any of you been following the financial conversations? I know that we've got the doom and gloom conversations of, oh my God, it's terrible. We're all going to catch a cold and die. And, and it's China's fault and, stuff like that, which I don't know whose fault it is, but it is what it is. But have you been following the financial side? I want to know how many of you have been following also the financial conversation in addition to the conversation that involves, this very serious issue of this, this virus that could become, a global pandemic sort of situation. So don't let me, by any stretch of the imagination, understate the potential significance of this virus and what it could do to the world. So I want to make that clear. I'm not joking about the coronavirus as if it's something that shouldn't be thought about, but I have researched it. And so what I'll start by talking about, what I've seen from a scientific standpoint. In terms of science, most of the experts seem to be saying that the coronavirus looks a lot like the flu. It looks a lot like the symptoms are very similar to the flu, and they don't seem to know much about it. And I think that's what scares them about the virus, is that they don't know much about it. And in fact, actually, the word for today, when it comes to not just the virus, but also media and the investing world, the word for today is fear. So type fear in the chat. The word for today is fear. Fear is a huge factor when it comes to stock market investing. Those of you who've been in my class will know that, we've talked about this in terms of psychology and fear and how that plays out in a what I would almost call a self-fulfilling prophecy. And by that, I mean, something where it may not be real, but it doesn't matter if it's real or not. You make it real when you start talking about it as if it's real. If I think that, my wife is cheating on me, and I go and I decide to try to kill myself or try to kill her or go kill the man that I think is her boyfriend, then what's happened is I've taken something that's not real and made it into something real. It's the imagination has very real consequences. So the biggest factor that I'm observing here is, as a guy who studies stock markets, is I'm noticing how the public's reaction to the coronavirus is impacting our actions and activities. We're not doing the things that we normally do. I flew out here. I'm in Oakland now. I'm doing a financial event tomorrow in Oakland. You can go to drboyseminars.com if you want to come out. And on the way here, I'm sitting on the plane and I sneeze, and I'm thinking, oh gosh, if I sneeze, I wonder if people are going to think I'm sick. Oh, that's right. Airplanes, they circulate the air. If somebody on this plane is sick, then, it can affect us all. In the summer, when Alicia and I get married, we're going to go on a cruise for our vacation or for our honeymoon. And I was thinking, oh gosh, we'll be on a cruise ship. What if something happens on the cruise ship? And it's coming out of Italy, and Italy has the virus. Like all these thoughts go through your mind, and it doesn't mean that it's not real, but it does mean that you have to be really cautious about distinguishing between what you know and what you don't know. And in fact, if I was to dissect the fear that's driving the market right now, you could dissect it as the fear of the known, right? We have known cases, we have known deaths, we have known impacts, known activities and actions that have taken place as a result of what has happened with the coronavirus. Then you've got the fear of the unknown, right? We don't know if China's telling us the truth. We don't know exactly how many people have been infected. We don't know what this virus is going to do next, right? And then there's the fear of the unknown unknowns, right? So you've got, the fear of just all the factors and variables that may become variables that you haven't even thought about. Like we don't know what the virus is going to do and how the virus is going to work, but what if there's another hidden shoe that's going to drop related to the virus that we haven't even thought about yet? And I think that's what's really fascinating. I'm not going to say fascinating because that almost sounds like I'm enjoying it. I'm not enjoying it. It's not a good thing. It's not a good thing to lose as much money as a lot of us have lost in the stock market. And it's not a good thing to have, the concern about a global pandemic possibly hitting the earth. That's never a good thing. But it's interesting because all the variables are kind of moving around. And what you're seeing right now is due to this uncertainty, where you have the fear of the known, the fear of the unknown, and the fear of the unknown unknowns all moving the market at the same time. I would almost argue that it's the unknown unknowns and the unknowns that are dominating the knowns, right? So you've got that little bit of fear of the things that are out there, but then the things we don't know, and the things we don't know. I think that's really causing a lot of panic and a lot of dispersion in the way stocks are being traded. And dispersion is basically where you have very fuzzy information. You have different interpretations of that information, different investors, different players all coming together, and all of them are acting on different information sets that they may have, some of which are more reliable than others. So you and I are trading stocks. That's how stocks get traded. What stocks go from one person to the other. So I'm trading because I talked to my friend at the CDC who told me, oh yeah, the government's not telling you everything. There's, they actually found 10,000 more cases that they haven't told you about, and it's only going to get worse. So maybe I'm trading on private information, and then maybe you're trading on, on a conspiracy theory that you believe in, that perhaps, the coronavirus is a weaponized virus designed to wipe out, half the population or whatever, right? Like we could all be arriving to trade, and we're all trading for different reasons. And that is my interpretation of what you're seeing in terms of this extraordinary amount of volatility. The stock market tends to have more volatility when there's a lot more trading and there's a lot more information flow. The market is driven by information and expectations. So as information's arriving and the information shifts expectations, you're just going to see all kinds of activity. And what I mean by shifting expectations, you're not just talking about expectations of consumers, of, what's my job outlook going to look like? If companies are cutting their capital spending and they're not going to hire as many people as they were going to hire before, then that's going to affect, whether I can get a job. Expectations in terms of what companies expect to earn this year. You saw a lot of companies making announcements immediately after the virus talk began, where they were shifting their expectations. So expectations aren't just something that you expect to happen. They're also something that can be kind of shifted and manipulated, where a player that has more information than you, like the CEO of the company, can give you information and say, hey, look, I know I told you guys that we were going to make, have 10% revenue growth this year, but now because of the virus, it's going to be flat. It's not going to grow. So that's me managing your expectations, which is also going to shift the stock price. So you're really seeing a lot of crazy activity happening. So what I'm going to try to do is break a little bit more of this down for you and also answer some of your questions directly. Some of you from the Black Business School submitted your questions in advance. And what I'm going to do is to keep myself focused, because my brain is overstimulated with this. You can probably tell because I'm talking a lot. But I'm going to answer those questions and make sure I commit to that, make that, or follow through on that commitment I made to you guys in the school. So here's one question from Lee Cameron. He says, what is the difference between a correction and a bear market? A correction is basically defined technically as when the stock market drops by 10% or more. I think that we're beyond correction territory. I think we passed that yesterday or the day before. The market has really seen some pretty dramatic drops 4 days in a row. I think it dropped by over 1,000 this morning, and then it went back up again. And so we're way beyond correction territory. Now, the thing about a correction, another distinguishing characteristic that distinguishes a correction from a bear market is that a correction typically reverses itself. So a correction, just since we're talking about viruses now, a correction is a little bit like catching the flu. If you get the flu and you get sick for a few days or for a week, you get better, right? You start to feel better, right? And life goes back to normal. Whereas a bear market is driven by some different sorts of issues. It doesn't mean you can't recover from a bear market. Remember, the thing I want you to hold on to when it comes to investing is the fact that everybody that's out here telling you that the global economy is going to crash and die, it's not to say that it couldn't happen, but it's never happened before. The stock market has never gone down and not recovered. In fact, historically, the last 120 years, remember I told you I've studied all this data over the years, in my research and stuff like that when I was writing all these papers for Syracuse University. And basically, the data says that anybody who bought heavily during a downturn usually made that money back. And so if I was to pick one key secret to investing based on history, based on what we know, it's always have a long-term horizon. Think broad and think long-term. That means buy lots of stocks and invest for a very long period of time. And that kind of wipes everything out. Then at that point, what happens for a long-term investor, typically, historically, based on history, I can't predict the future. Nobody can, just so you know, nobody can. But based on history, there's just never been a time where a long-term investor that was well diversified lost money, long term over, say, a 10, 12 year period. And so at that point, when you sort of diversify away all that crazy risk, stuff like this becomes a talking point. That's it. It just becomes a talking point. It's like, yeah, the market's really doing some interesting stuff these days. Woo, maybe I should adjust my portfolio, but it's not sort of one of these epic transitional decisions you make, like, should I take all my money out of the stock market? Maybe I should never invest again. Like, that's a lot like having a bad relationship and saying, I'll never date girls again. Like, when your teenage child tells you that, it's because they don't understand love and they're overly emotional, and you just kind of laugh it off, right? So don't allow, but then it gets serious, right? If the teenager does something crazy, like decides to kill themselves because their girlfriend broke up with them, right? At that point, you would say, no, there's other girls, there's other fish in the sea, things will get better. So I would say that with investors, I would advise you heavily, in my opinion, my thought, this is not investment advice. I'm teaching, I'm a finance professor. I want to make sure for legal reasons that you don't classify it as this, but my goal would really be to persuade you to just never commit financial suicide. Like, never get to the point where, and this is something John Rogers wrote about. John Rogers is a billionaire. He's a brother out in Chicago. I really like this guy. I met him a couple of times, and I liked him when I talked to him. He talked about how many Black people committed financial suicide during the 2007 market crash. They just said, oh my God, the market crashed, I'm getting out of stocks forever. And what he was explaining is that so much Black wealth was lost, probably trillions, like more than whatever amount of money you think that they're going to give you for reparations. A lot of that, a big chunk of that was probably lost just by the Black people who left the stock market in 2007, 2008. So you're cheering on the election of President Obama, but you're committing financial suicide at the same time. Which could be one of the reasons your community isn't moving ahead economically, because you focus on, they give you the social stuff, you start feeling, they give you the feel good moments, but you don't actually get the economic strength that should come with being a full-blooded American citizen, right? So, and that's not always their fault. Sometimes it's based on your own decision, right? So I would almost say, if I was to walk away with anything, number one is a lot of this is driven by fear. Fear kills financially. Fear kills everything, because the strength of an economy is built around the strength of its economic relationships. And any relationship is built on trust. Any relationship is built on, a commitment to the desire to connect, overriding the fear of what goes wrong if that connection doesn't go bad. So if you're going and you're thinking about going to sleep with somebody, and you're thinking about how good the sex is going to be, then you're probably going to show up. But if you're going to sleep with somebody and you're thinking, oh my God, that person might rape me, right? You're not going to show up. You're going to say, oh, I'm going to say, oh, no, I'm not messing with that because I don't want to be traumatized, right? Well, the same thing is true with financial trauma. Like, when the economy is safe and good and happy, like it's been for about the last decade, um, you know, everybody feels safe. Everybody feels good. So there's lots of love making going on. There's lots of business deals being done. Companies are spending money. Consumers are spending money. Everybody's investing because there's plenty of trust. Nobody's feeling like they're going to get ripped off. Banks are making loans. There's free money flowing everywhere, which stimulates activity. Now you're in a climate of fear. Where a lot of these hookups, these financial hookups that would have taken place. Give me a second, guys. I got to shut this window. There's a truck outside making so much dang noise. By the way, I wanted to mention to you guys as I go over here, if you want to join my stock market class, we're offering a temporary promotion where you can join the class this month for $1. It'll be $1 for the first month. And if you like it, you can stay. You'll be billed for the next month, but for the first month, you can get it for $1. You can go to theblackbusinessschool.com, theblackbusinessschool.com, and look for my stock market classes, Black Money 102, and you can use the code word. What is it? I think it's $1 stock market, $1 stock market. So, or you can also go to the black stockmarketprogram.com and use the code $1 stock market. So give me 1 second. I'll be right back. Okay. I'm back, guys. Sorry about that. There was so much freaking noise outside. It's like, sheesh, what is going on? All right. And I'll try to just give you a direct link. That way you can actually just click the link and go in if that's something you want to do. Okay. So that's the difference between a bull market and a bear market. A bear market is typically different from, the difference between a correction and a bear market. A bear market is typically a little bit steeper than a correction. A bear market tends to be about 20%. And it occurs for different reasons, right? A bear market tends to happen because there's a real bad shift in sentiment. A bear market it sort of tends to occur when investors are afraid and when when the economic activity is starting to kind of fall off. And so a bear market is a little bit scarier in the sense that if you say that a correction is like catching a cold or catching the flu, a bear market's like getting depression. Like if you're depressed for a long period of time, you may never come out of that cloud, or it may take you a long time to come out of that cloud. So bear markets take longer to recover from because they're driven, I would argue, by stronger fundamental reasons in terms of investor sentiment, how investors feel and companies feel. Because remember that we talk a lot about investor sentiment and consumer confidence, but what also matters is the sentiment of the people that are running the companies and their confidence. If I'm a CEO of a company and I feel like the world's coming to an end, I'm not going to go out and make major investments and hire new people and go hire contractors and suppliers. I'm going to hold on to my cash. If I'm a bank and my sentiment is bad and my fear is high, I'm not going to go out and make a bunch of loans. I'm going to hold that money close to my vest. And that was the biggest problem that Obama had back in the day was Obama, passed that massive bill where he got all this money for the economy and he gave it to the banks and the banks just held the money. They literally didn't spend hardly any of that money or loan out any of that money. So by the way, guys, if you're watching, whether you're online or inside the chat, I just shared the link directly where you can go in and get access to my stock market class for $1 for this month. So the link will be active for 24 hours. So feel free to click on that link if you'd like to join our stock market investing class. You get a certificate when you're done. You'll learn all about the stock market. So feel free to check out that stock market program. Okay, so the next question that was submitted by the Black Business School students is Barbara Jordan. Barbara Jordan writes, how does the coronavirus connect with the stock market as far as movement of the market? Okay, so Barbara, I did hit on that a little bit. The coronavirus, it drives, it starts off psychological, right? The psychology is the key factor here. Like that's the thing that's causing all the major movements. But usually when we have a perception of fear, there's usually something that, there's some possibility or some realization that confirms that fear, right? Like I could be afraid of something just out of thin air and it could be a complete figment of my imagination, but the market is not delusional in that way. The stock market is full of a lot of intelligent investors and analysts who, are looking at data and information and saying not just, what's happening now, but they also get paid to look at all the what ifs. Okay, what's the probability this is going to happen? What's the probability that's going to happen? I call that going to the fourth dimension, right? You live in 3 dimensions. You've got, length, width, and height, and what's happening in the world right now. The fourth dimension is time, and the fifth dimension to me is not just time in terms of what's happened all throughout the past and in the future, but then there's the fifth dimension, which is actually not just what's going to happen in the future, but all the things that could happen in the future. And the fifth dimension is like, not just what happened in the past, but all the things that could have happened in the past, right? So analysts, stock market analysts have to be kind of fifth dimensional. I said 4 dimensions, I actually meant 5. And by fifth dimensional, I mean this. Let me break it down and make it real simple. Basically, it means you're not just looking at what's here in the here and now. You're looking at the future, but you're not just looking at the future in a direct sense because nobody can see the future, right? But you can see all the possibilities of the future, right? So for example, if I'm holding this ink pen and I say, what is Boyce going to do with this pen, right? So you can imagine all the possibilities. Let's say I tell you there's a 50% chance I'm going to drop it to the left, a 50% chance I'm going to drop it to the right. Well, in a 50% chance, I'm going to just hold it and lift my arm up in the air, right? So there's 3 things you might do. And let's say that each outcome has a 33% probability. Well, you can actually price that into an investment or into a bet, right? So somebody can actually take bets and say, if you put up this much money and Boyce drops the pin to the left, then you'll get that much money. If he holds it up in the air, you'll get that much money. If he throws it to the right, you'll get that much money, right? So that's kind of how the stock market works. You're looking at things in a fifth dimensional context where you're looking at what's here and now, the past and the present, and the future, but you're also looking at all the possibilities of all the things that could happen. So let's look at the realization. So let's see what Boyce is going to do with this pin. 1, 2, 3. Okay, Boyce dropped the pin to the left, right? So that is what is called a realization, right? So now expectations are out the window. Before, all the movement, all the conversation, all the market activity was driven by expectations and probabilities. It was driven by what I might do, what might happen, right? The known, the unknown, and the unknown unknowns of what Boyce was going to do with this ink pen. But now you got what they call a realization. Now, instead of speculating on who's going to win the NBA finals, the finals have been played out and you know who won, right? So once the realization hits, you compare the realization to the expectation. So let's say that 95% of you thought that I was going to throw the pin to the right. Only 5% of you thought I was going to throw it to the left. Well, that would have affected the price of the bet. That would have affected the price of the Boyce stock, if you want to call it that, right? But now that you've seen what actually happened, that I threw it to the left, then the price is going to correct itself. It's going to adjust based on new information. So there's new information now that says, okay, Boyce threw the pin to the left. Okay, we thought he was going to throw it to the right, but we knew we were wrong. Now we're going to go this way. So what's happening now is the market is really managing a lot and trading on a lot of expectations and possibilities, and not just expectations, but expectations of future expectations. Right? It's really, statistics can become a real dark black hole if you really dig deep into it, and so people are just waiting to see what happens. And so for myself as an investor, my biggest move, honestly, is I look at the long-term trends. So I'm still buying. I've been buying the whole dip. The whole time we've been dipping. If it dips, I buy. If it dips again, I keep buying it. I just keep buying. I just buy dips. That's just what I do. Not because I specifically know anything in particular or exactly how this virus thing is going to hold up, but because I know history. History says if you typically just buy dips, then you're usually going to be okay long-term, theoretically. Again, no promises. So I want to make sure that you don't think anybody's ever 100% accurate at predicting the stock market, because I don't want you to get mad if things turn out different from what you expect. But the other thing too is that there's a wait and see attitude. You want to consume information and then consume information from the people who are consuming better information than you. That's where analysts come in. That's where listening to the CEOs of corporations come in. That's what people on Wall Street are doing right now. They're watching the news. They're like, what is Trump going to say? Because they know that what Trump says is revealing information about what's actually happening, what's being done. But then it also reveals information about how the administration, whether or not they can even rely on the administration to have an adequate response, right? So that can even shake up the market. If Trump's reactions, if the words coming out of his mouth are a little shaky or contradictory to what somebody else is saying, all that does is it creates more market confusion. So that's why you tend to see, when you tend to see drops like this, you tend to see a lot of volatility. You tend to see a lot of ups and downs, up and down. So if you look at the market today, for example, today on February 28th, 2020, I'm going to look it up now because it's probably changed since I started this conversation. Let me see here. So the Dow Jones today is it looks like we're down at this particular moment. Is that 835 points? Yeah, okay, that's a big deal because I think earlier we were down, over 1,000, and then yeah. So right now it's at 2490 or 24,910. It was down as low as 24,706. Then it went up to 25,408. In fact, let me see if I can show you guys my screen right quick. Hold on. Let me pull this up. Hold on, guys. Give me a second. I'm just going to share my screen. All right. And Dual, if you're watching Dual, share that link for the $1 stock market class if people want to join that. All right. So here you can see what the Dow Jones Industrial Average has done today. This is a lot of volatility. These are major moves. So you see in the morning we start at 25,288, and then you see where it drops as low as 24,682. So that's massive. That's a pretty huge drop. And then you're kind of hovering along in this drop territory. But even within that, you're seeing a lot of mountainous behavior. And then you see apparently there must have been some good news released. Somebody might have just sneezed in the wrong direction, and you suddenly see the market climb back up to 25,408, which is crazy because that's higher than it was at the beginning of the day. So everybody's happy, and then you see a dip, then you see a rise, then you see a big drop. So the market's pretty bipolar right now. If you look at the 5-day outlook and what's happened over the last 5 days, you're starting here at 28,402, which is an insane level. You've seen it drop down to 24. So a lot of people are crying in their beer right now because you've seen a big drop. This is the last month. This is what the market's done the last month. It's been pretty flat for most of the month, and then it drops here. Now let's go back. Let's look at the last year though. So look, remember a year ago, you were dealing with 25,000, right? But now a year ago, 25,000 was seen as a historic high. 25,000 was seen as, oh my God, the market is so overpriced. 25,000 a year ago was seen as, oh my God, the stock market's really taking off. Maybe I should wait for it to go down before I buy again. But you see that since that time, it's gone way up. So in a way, what you lost here, some would argue that you're just losing what you gained kind of over the last year. But if you go back and you look at the 5-year trend of the market, you see that this market that is at 25,000, where we're complaining because we went from 28 down to 24. Well, in 2016, if you started investing then, you could have bought in at 16. So imagine if the stock market dropped today from 24,948 to 16,204. How traumatic would that be? I mean, people will be crying in their beer. The freaking, the news will go crazy. It'd be a state of emergency. Everybody would go nuts. But the reason everyone would go nuts is because every number is usually being compared to another number. That's why I believe, and again, this isn't something, honestly, I think this is something that took me 25 years to really process properly. So most people who, have an MBA and have been doing this for 3 are going to really see this. I had to teach finance for 20 years in order to really to see this small, tiny, simple point, which is that all numbers, there's really no such thing as a big number or a small number most of the time. All numbers are compared to another number. All things are relative. What's a tall person? Is there a universal definition of what it means to be tall? No, there isn't. Is there a universal definition of what it means to be short? No, because a person a guy who's 6'8" could be considered short if he's standing next to a guy who's 7'3", right? Or a 5'10" guy could be seen as tall if he's in the 5th grade and all the other kids are 5'1". So this is kind of what you're seeing. So if you started investing in 2016, this is my point. If you started investing in 2016, and I've been teaching this stuff long before then, stock market class, for example, was around in 2016. If you started investing then, and just did what we talked about, just did what I told you, don't even overthink it, and invested consistently, even with this major crash, you would have made an absolute killing. You would have gone from 14, 15, 16,000 all the way up to 25,000 on the Dow. If you go back and you look at this chart over the max period of time, a lot of you are over the age of 40. How many of you are over the age of 40? Then that would mean that you could have started investing, say, 20 years ago. If you started investing in the year 2000, you could have bought in the Dow when it was at 10,733. If you're a little bit older than 40 and you started investing in 1995, you could have bought in when the Dow was 3808. 3808. Compare 3808 to 25,166. That's insane. Imagine if you had a time machine and you could go back and talk to yourself 25 years ago when the Dow was at 3808, and imagine how stupid you would sound. I'm not calling you stupid, but we would all sound stupid. But seriously, it's okay to call yourself stupid because we're all stupid compared to our former selves. I know I am. I was a dummy 10 years ago compared to the man I am now, right? And so I would go back in time, and let's say that I talk to myself in 1994, 95, and I say, go buy into the Dow, invest consistently, invest a lot of your money. Let's be a consistent investor. And let's say that, my little 1994 self, thinking that he's smarter than he actually is say, because I was smart then, right? I was teaching college students actually at that, even then. So imagine if my so-called smart self was like, no, I don't want to invest now because the market just went up by 20%. And I want to wait till it goes down because I feel like, everything's overpriced. That would sound absolutely stupid for me to say that when you're comparing that to the future, right? So what I'm saying is that the same way that, your current self would look at your past self as a complete idiot for telling you that it doesn't make sense to invest when the Dow's at 4,000, there is probably a future version of you 20 years from now that would call you an idiot if you said, well, I'm not going to invest because the Dow's all the way up to 25,000 and that's just really high. Or you would look silly if you say, oh, the market just took a big drop, I'm going to wait, I'm going to, or I should buy now because it's really, really cheap. Like, there's no such thing, honestly, and a lot of times, as cheap and expensive. I mean, it exists and again, I want to be careful when I explain this, because a lot of people who don't understand investing, they get confused by what I say, and then they think that I'm saying something that I'm not saying. Like, so for example, when I said that the racial wealth gap was an illusion, and I explained what I meant by that, there were people on the internet who only read headlines, and they took the headline and said, oh my God, who would ever say it's an illusion? I wasn't saying it was actually non-existent. I was saying it's an illusion in the sense that it's a distraction that keeps you from focusing on the issues that matter the most, right? So the same thing is true here. I'm not going to say to you that there's no such thing as overpriced and underpriced. What I'm saying to you is that everything is relative, and most of the time you're wrong. Most of the time, you can create a context in which everything you're saying is completely correct, or everything you're saying is completely incorrect. So what I'm really just trying to say is that I think a smart investor focuses on the basics and the fundamentals. What are the basics? Well, the basics are that there's never been a time in American history where the market has gone down and never recovered. That means if I'm a long-term investor and I'm well diversified, then chances are I'm going to get my money back and I'm going to make more on top of that. Doesn't mean that there's any guarantees for the future, but that's probably what's going to happen right now. What's another universal feature? Well, if you're able to do things in the past, you're usually better off investing in the past than you are in the future, no matter what the prices are, right? So for example, like real estate, there is almost no place you can go in the world, or in America anyway, where you could buy a house now for an amount that's cheaper than what you could have bought it for 20 years ago. There's nowhere out there, right? So if you were to, talk to your past self though, and when you were actually in that moment and could have taken advantage of that opportunity, could have made a move right then, you didn't have the perspective to make an accurate decision. So you probably said something like, yeah, these houses in New York City, gosh, they used to just be 100,000. Now they're 200,000. That's too much. That's overpriced. I'm not going to buy, right? But now that $200,000 house is worth $800,000. And now you're like, damn, I wish I'd had some perspective and some vision. So typically, people who do better in stock market investing tend to be people that have patience and that have vision. They can see broad and they can see long. Like LeBron James is a great basketball player because he has tremendous court vision. He can see the entire court. He can not just see where everybody is, but he sees where everybody's going to be and stuff like that, right? So if you're an investor and you have broad vision, broad, long vision, meaning that you can, and patience as well, where you can just kind of wait it out, you're gonna do pretty well. You're typically gonna do okay. So anyway, let me keep going. Okay, so some of you asked for that link again. So yeah, if you want to join my stock market class for $1 for the first month, there's the link. I'm sharing it with you guys in the chat. So feel free to join. It'll be good for 24 hours. You can actually go and sign up, and the first month is just $1. and then you could try it out. And if you don't like it, you can leave. But it's really good. I think you're going to like it, and you should stay, and you should bring your children and your whole family, because all Black people need to know this stuff. Black folks need to understand these things, in terms of how wealth works and how investing works, because there are other communities having these conversations. There are people in the Jewish community who are having gatherings to talk about their stock portfolios, and there are thousands of people that want this, to have these conversations. And so whereas I think that there's a segment of our community that's completely oblivious to it. Maybe they're hanging out in the shade room and they want to see which rapper's girlfriend is twerking on Instagram, or which Hollywood actor is going to put out a movie next week. And these are the things that drive economic strength. And these are the things that drive economic growth. What's the cost of month after month? It's $89 a month typically, but today you can get in for the first month for $1. So if you want to just come in and use it for a month and get everything you want and leave at the end of the month, that's totally fine too. But the Black Business School, we offer better quality training than what you'll get in college for a much, much lower price. $89, that's about $3 a day. But that $3 a day will change your life. And I think you guys have seen me enough to know that I understand some things that can really be a benefit to you and your family. Okay, so let me answer. Let me see. I see one more question here from the students. I'm going to answer those first. Hey, Doc, this is from Derek Rowe. He says, "Hey, Dr. Watkins, how do you feel the media is spreading fear about this virus?" I think the media is the biggest culprit in all of this. The media is driving so much of everything here. I mean, I was talking to Alicia the other day about it, and we were talking about, Ebola. And I was like, I said, what happened to Ebola? I mean, does anybody else remember how scary Ebola was? Like I remember being really scared of Ebola. Like I really thought that, I really thought that Ebola was possibly like the end of everything. I mean, people were vomiting their guts out, and it was easily transmittable and just it's scary. And then Ebola just disappeared. And I remember thinking, where did Ebola go? Like, is it still out there? Like, did they, and what I really realized is that a lot of times what becomes real to us is whatever the media is talking about. So here's what is interesting. I'd like to see what occurs. Number one, I want you to mark this date, February 28th, 2020. And I want, in 1 month, March 28th, 2020, I want you to check the media and see how many headlines, how many news outlets are still talking about the coronavirus. If that number has dropped significantly, then I bet you that the stock market will have really recovered dramatically. If they're still talking about it and it's gotten worse, there's a chance we could still be in a bear market and possibly in a recession. I think that this virus could actually drive us into a recession, due in part due to what's real, but also in part due to self-fulfilling prophecy. Because, when I'm looking at the analysts and hearing what they're talking about, and when they're talking to the CEOs, a lot of companies are already making adjustments as a result of the virus. Amazon, for example, told all their employees to defer all non-essential travel. That's huge when Amazon makes an announcement like that. Now, they may be making the announcement because they really believe the virus is a danger, or they could be making the announcement because they think everybody else believes the virus is a danger and they just want to fit in, right? There is what they call a herding effect. Herding effects are where people don't always do stuff just because they know it's the right thing to do. They're doing it because everybody else is doing it. And they know that even if it's the wrong thing, they're still going to be okay because everybody did it. So nobody's going to blame you if you make a mistake. But if you do something different from what everybody else is doing, and then you turn out to be wrong, then they're going to say, well, what was wrong with you, you idiot? You should have did what everybody else is doing. So studies show, one of the actually individuals on my dissertation committee was a guy named David Hirschleifer. He's one of the world's leading experts in this herding effect for investors and for corporations. And what Professor Hirschleifer, I remember, us talking about this, and we wrote some stuff on it. CEOs tend to herd with one another. CEOs tend to be copycats. They tend to, out of safety, they believe there's safety in numbers. So if they start seeing all the other CEOs, cutting essential travel, then they'll do it too. If they see all the other companies announcing that their earnings are going to be lower, then they'll do it too, just so they can sort of fit in, because that's just kind of corporate culture. That's how you keep your job, is you fit in, because when you stand out, and if you make a mistake when you're standing out, then you're going to be punished worse than if you make a mistake, that the same mistake everybody else makes, right? So just know that herding effect is real. It does exist, and it is going to impact stock prices. And what you don't want to believe, though, is that just because everybody's doing it, that it's the right thing to do. I was going to share another thought on that. That's why I'm looking around, but I can't remember what the thought was. So I'm just going to answer another question. All right. So let's see here. Should I buy more precious metals? I'm not going to tell you what to buy. I don't really do that. But I do think having precious metals as part of your portfolio is always a good strategy. I think diversification in general is a good idea. Jimmy, do we buy or do we wait till the price goes lower? You know what? I'm buying right now, but I'm not telling you what to do because I don't really make stock recommendations and I don't give investment advice. But what I will say is that I am buying right now because, again, historically, buying into the dips usually ends up being a winning strategy. Let's see. What do you think about the Dean Koontz book, The Eyes of Darkness, that talks about a virus from Wuhan, China, hitting the world in 2020? In the book, it's called Wuhan 400. Wow. Are you kidding me? No way. Really? Wow. I'm going to write that down. That's interesting. That's even more interesting than that cartoon where Kobe Bryant got killed in a helicopter crash. And the other one from The Simpsons where they have from 20 years ago when they had Trump going down an elevator running for president. Let me see here. It's Dean Koontz. I'm going to look that up. The Eyes of Darkness. Thank you for telling me. I didn't. I don't know, man. Maybe it's the Illuminati. All right. So, okay. Next, Kevin, do you know of any apps that allow for or are designed for investment in U.S. stock from outside the country? I believe Stash and Robinhood and stuff like that are trying to move to the UK. What I would do is, look and see what the major investment advisory companies are in your country, and then connect with them, see what apps they have, and then try to find out what other apps out there, that people are recommending. Because I find it just really strange that Stash and Robinhood and Acorn can't expand outside the U.S. very well, but it's largely because stock markets operate differently in different countries, and so there are different rules and laws you have to kind of circumvent in order to make things happen, or not circumvent, but abide by. You don't want to circumvent the law. Let's see here. Maleka Velasquez says, does this also affect metals and the Forex market? Yes, all markets are affected by this. All markets. The supermarket is affected by this. You go to the grocery store, you won't be able to buy a surgical mask. I tried to buy a surgical mask on Amazon, for Alicia and the kids, and I saw these masks that were like $50 for 100 masks, and I was like, oh, that's a good price. So I was about to buy it, and then I saw the shipping, and the shipping for this $50 product was $370. So Amazon had warned against price gouging, which tends to happen when everybody's afraid of something. And so it's already happening right now. Let's see here. What does option chain mean, says Jeanette. Option chains, that's something that's beyond the scope of this conversation, but that kind of goes into basically setting up options in a specific way. In the stock market class, we actually talk about option chains and options and things like that. But I wouldn't really get into that too much because I don't think that that's relevant to what we're talking about in terms of the scope of our investment conversation. That's something that's a little bit on the technical side. Let's see here. Jeanette, what does buying futures mean? Buying futures basically means you're buying something in the future. So you can actually buy things. The stock market is great for the manipulation of time. Like there are what I refer to as financial time machines, where you can actually make a transaction. Like, for example, let's say that I'm planting corn and I'm worried about what the price of corn is going to be by the time I get my harvest. So if I'm planting corn now, I can make a deal to go ahead and sell my corn 6 months from now at a certain price, right? We can make a deal for the future and just say, no matter what happens between now and then, you're going to buy my corn at this price and that's it. So some people buy into those futures because they like that gamble. They like the idea of locking something in for the future so they can benefit if conditions change. Like if corn suddenly becomes super valuable and you bought it at, $1 an ear and it goes up to $1.50, then you can make a lot of money because you get to buy that cheap corn and sell it, right? But farmers on the other side of the equation, they're not looking to benefit from the upside. They just want to minimize the downside. So you have different types of investors that trade for different reasons. They have different information sets and different perceptions of risk. And so a farmer might trade with a risk taker because the farmer might say, look, I don't want the risk that, my crop is not going to be worth what it's supposed to be worth. I don't care about the upside. I just want to defend myself from the downside. So they might make a trade with somebody who says, sure, I'll take that bet. I'll take that risk off your hands, right? So risk does get transferred, from person to person or entity to entity. You can actually transfer risk. Let's see here. Kai says, is there such thing as a bad stock? Yeah, I think that there is. But what's supposed to happen in a properly functioning stock market is that every stock is supposed to have the price that it has. It's supposed to be the best price available based on the existing information about that stock. So ultimately, in a good market, there is no such thing as a bad stock. Because all investments have been vetted, all the information that's out there has been properly processed, and the pricing is based on exactly what the price should be based on the information that's out there. That's the fairy tale definition of what it means to price a stock. The realistic definition or the realistic interpretation is that all information is not out there. Everybody doesn't have the same information. Emotion, human emotion, and things like that can play a part in causing something to become overvalued. What's his name? Alan Greenspan, who was the former chair of the Federal Reserve, wrote a book. I think it was called Irrational Exuberance, where he basically talks about how stocks can become overvalued because people get super excited. And it's not that they're not aware of the risk, it's that they don't care. They're just not afraid anymore. So it's like driving down the highway, you're going 120 miles an hour, not because you don't think you can't, you're not because you don't think you can crash, but because you just ain't worried about it. You've never crashed before, so it's like no big deal. Whereas somebody else driving the same car might drive slower if they've already been in a car crash. Or maybe if you have that first crash and you're in the hospital for 6 months, you'll probably drive slower down the freeway. So the stock market, when it doesn't crash for a long time, there is a risk of irrational exuberance where people just start thinking that prices can only go up and they'll buy at any price that they possibly can. And they're just looking to make a fast buck. And I think that's just bad investing. But if you do, but one thing that does justify kind of buying nonstop relentlessly on a consistent basis over time is that, going back to that basic idea I mentioned to you guys before, that there's never been a time where there's been a crash and the market didn't recover. So that means anybody who, let's say you had a great grandparent in the 1930s who just said, I'm going to just buy stock all the time because I want to own stock for my great grandkids. Like I don't care if the market crashes or does well or does badly. I don't care what it does on a given day. Every day I'm just going to take, $100 or $100 a week or $100 a month or whatever. And I'm going to consistently buy stock on a regular basis. Well, there's a good chance that a person like that could have easily made you into a millionaire without having any knowledge of investing whatsoever. Just by full participation, consistent participation, they would benefit, because overall, the reason that for the wealth gap in America, the reason that wealthy people have more money than regular people is because wealthy people put a lot of their money in the stock market and a lot of regular people do not. Stock market participation rate. In fact, if they wanted to close the wealth gap, one thing that any president could do to close the wealth gap, in my opinion, is if they required everybody to invest in the stock market. Now, of course, that could be criticized as helping the wealthy, right? Because you're pumping up stock prices, and wealthy people tend to benefit more than everybody else because they're so heavily invested in the stock market. But I'm a believer, like if I could literally go into every Black person in America to do something for their children, I would force them to take the same amount of money that they put into fast food and put that into stocks, and just buy a new stock every week or a couple of new stocks every week, and do that consistently. And new stocks meaning something other than what you already own. And if I could get 40 million Black people to do that on a consistent basis and do that for 20 or 30 years, in 20 or 30 years, we would have more wealth than white people. Like on a per capita basis, we would be wealthier on a per capita basis than white people, Asian people, Jewish people, and everybody else, because that's the big window. That's the big opportunity. Now, is that going to be true for the next 100 years? I don't know. All I know is that over the last 100 years, it was certainly the case. So, so the big message, the big takeaway is keep moving forward. You got, to build wealth in America, you got to be an investor. America's capitalism is not built for workers to prosper. It's not built for people to prosper if you don't invest. It's not fair. It's screwed up. Maybe Elizabeth Warren is going to change that. Maybe Bernie Sanders is going to make the country into a socialist country. I have no freaking clue. All I know is that if you give me two Black people born into the same oppression, same situation, and one of them consistently invests and the other one did not, the one who consistently invests would not be poor, would not be poor. I'll share this last story and let me share this link with you guys. If you guys want to join the stock market class for $1 for the first month, it's $89 a month, but you can get in this month for $1. There's the link right there. I'm sharing it in the chat, so feel free to use that link. It'll be good for 24 hours. But there's a lady I knew who was so poor when she grew up. She grew up in the hood. Is poorer than probably anybody else in this room. And they were so poor, they didn't even have a refrigerator in the house. It was wintertime, so they put their food on the porch to keep it cold. And they eventually got a refrigerator by springtime, and it was an old used refrigerator. So anyway, that's how poor they were. But here's the thing about her family. Her mother believed in education, so her mother made her read every day after school. She wasn't out twerking. She wasn't out memorizing Cardi B lyrics. She wasn't out, thugging. She wasn't out, hanging out with whoever. Her mother had her reading every day after school. So she got really into her education because she explained that education is the key to success. That was all her mother knew. Her mother knew nothing about investing financially, but she knew about investing as a human being, investing in your child. So she invested in her child like a good mother did. And her father was also a smart man. He didn't know anything about investing, but he also told her to invest in education. So then she gets older. She gets a college scholarship, one of those scholarships they give to poor kids, because again, they were super, super poor. And but she goes to college and she does well in college and then eventually goes to grad school. Now, while she's in college, her father said, be careful about student loans. Don't go deep in debt while you're in school. So she kept her debt level relatively low. She only borrowed what she needed, which is in contrast to a lot of our culture, where you see a lot of, how many of you have ever seen kids go to college and borrow money that they don't even need, like just so they can have an extra $3,000 so they can go buy, a Gucci purse, or have extra money so they can buy some Jordans or whatever, or they want to go party, they want to go to the club and make it rain like a rapper, right? Have you ever seen, we just have too many people that just, unfortunately are geared and trained to be financially unproductive and backward. Y'all know what I'm talking about. Don't act like you ain't black up in this mug. Seriously, come on. I'm not dissing my people, but I'm challenging my people to observe behavior that is not conducive to your success. So she didn't do all of that. She handled her business, borrowed only what she needed. Her student loan debt was about $20,000, so it wasn't very much. And she went to grad school and she got a lot of education and she eventually got her first job. Here's what happened. She got her first job. Her father did not. Tanya says, I don't see the link here. I'm sharing the link with you, Tanya. There you go. And so she got her first job. And when she got her first job, her father didn't know much about investing, but he did know. He read somewhere, and because he was a reader, and he said, I read that you should max out your 401k, especially when you're young. Now, so what she does is she's like, they asked her on her job, they said, well, how much do you want to put in your 401k? She said, I don't know. My dad said I should max it out. So just max it out, whatever the max is. So she did the max in her 401k. Pay attention, black people. If you're black, I want you to tell me if you're black. Yes or no. Are you black? All the black people in the room, I want you to say something. If you're not black, that's okay. We love you. You can be an honorary black person for today. So if you're black today, say yes or type B1 in the chat. If you are not only black, but you put black people first. This is for the black people in the room. This is for the black people in the room. I want you to think about this. That tiny little piece of advice her dad gave her. Now she's got 2 or 3 little nuggets that change the trajectory of her life, but this is important. So her father tells her, max out your 401k. Do most black people, when they get their job, max out their 401k? Or are most people thinking about having as much cash as possible in their pocket at the end of the week? Yes or no? Do most black folks manage their 401k? Max out their 401k? The answer is no. Go watch. There's a Saturday Night Live episode called Black Jeopardy. It's one of the little skits they used to do, and I hate Black Jeopardy because it ain't nothing but a bunch of stupid stereotypes that they perpetuate to keep you as stupid as possible, because they make you think that being stupid is the same as being black, or that being black is the same as being broke, or being black is the same as being self-destructive. So on Black Jeopardy, one of the questions on Black Jeopardy was, because you know how Jeopardy works. Jeopardy was where they ask you the question first and then you give the answer, right? And so the answer was, your boss wants you to max out your 401k. And the question, so the lady hits the bell, Leslie Jones, who just, she loves to just kind of coon out. And so she goes, you better give me back my $50 so I can get me some scratch offs. right? Now, I'm sure people laughed. The white people thought it was hilarious because they laugh at you. They laugh at you, right? And I'm sure a lot of the black people were like, "Ah, girl, you know that's funny. That's what I do too. Gotta get me some scratch offs, right?" But that's not funny. That ain't funny. That ain't funny at all. That's like making jokes about having sex with no condom. You might laugh it off in the moment, but having sex without a condom can kill you. So not investing, but you know that just the fact that we somehow allowed this, again, this show that's owned by white folks to perpetuate a stereotype that black people do not want to even invest minor amounts of money is directly linked to that statistic that everybody's complaining about, saying that black wealth is going to be zero by 2053. Do you understand how those two events are connected? I need y'all to connect the dots. Give me a yes. Please confirm with a yes to tell me that you're connecting the dots here on what I'm telling you. These things that you think are funny are not funny. They're serious. Because the reason this young lady did all of her broke friends from childhood is because she didn't go down the Negro path. She went down a different path. She didn't go down the stereotypical Negro path where it's like, oh, girl, you better give me my $50 so I can get me some scratch offs. No, her daddy said, no, you max out your 401k because you need to prepare for your financial future. Let me tell you where she got really lucky. This is where ignorance can be bliss. See, we make the mistake of thinking that more education is always an asset. Sometimes more education can be a liability, especially if it's the wrong education. There's a lot of miseducated people in our community, but when it comes to wealth, when it comes to a lot of things, like sometimes the smartest person in the room is the dumbest person in the room because they're headed 100 miles an hour in the wrong direction. Your intelligence allows you to move quickly and make these decisive decisions with tremendous confidence, but you're looking at everything in the wrong context because you were educated by people that wanted to oppress you. So they trained you to go 100 miles an hour in the wrong direction. You're running the ball and you're running a 4.3 40-yard dash. You're sprinting full speed down the field and you're running it into the wrong end zone. And that's one of the other reasons black people get held back is because some of our so-called smartest, most educated people, where did they go to school? Did they go to school, universities run by black people? Were they educated at places like the Black Business School? Or were they educated at Yale or Stanford or Brown University? No disrespect if you went to those schools. I'm not disrespecting you. I'm just saying that your education must be supplemented. They can teach you how to be a productive white citizen for sure. You need to go somewhere else to learn how to be black. You do not allow other people to teach you what it means to be a productive member of the black community because they're going to teach you wrong. So here's the point. Let's go back to this young lady's story. Started off so poor that the family didn't have a refrigerator. Got a good education because our parents pushed education in the household every day, something that a lot of our families don't do. A lot of our parents, unfortunately, will go to a basketball game before they go to a PTA meeting. A lot of parents will spend more money on a football uniform for their son than they will spend putting him into a class to learn how to start a business so he can survive economically as a black man. So she grows up and she gets educated. And then she finishes college, gets her first job. Her dad says, I want you to max out your 401k. She just does what daddy said. Here's where she got lucky. Here's where, Jesus stepped in or somebody stepped in and helped her with this because she didn't know any difference. Ignorance was bliss in this particular case. She didn't realize that when she started investing, she was investing the most at the very same time that black people were investing the least. She was going full steam toward the market right in the heart of the 2007, 2008 market crash. So she was running that way and the rest of the community was running that way. And the thing is, because she's not into financial stuff, she didn't know that she was running the wrong direction. It's like when there's a fire, and everybody sees everybody else running, so they start running too, right? Right. But you're like running in the other direction, right? That's what she was running toward the market when everybody else was running away. And what she didn't realize is that Warren Buffett, one of the richest men on the planet, says that's what you're supposed to do as an investor. He said you're supposed to be fearful when others are greedy and greedy when others are fearful. So I'll be willing to bet you that if you go look up Warren Buffett, if you Google him right now, I bet you that Warren Buffett is pulling out some cash right now and making some acquisitions of distressed assets in order to take advantage of all the massive amounts of fear that exists in the market. Let me just show you Warren Buffett. We're going to go back to the story about this young lady in a minute. Here's a headline. Warren Buffett warned you stock prices were insanely high. Let's click on news. Let's see what news is out here about Buffett. Warren Buffett discusses, okay, this is, let's see. He warned you, untangling his unique firm. He bets on these three high yield dividend stocks. So he's investing heavily. He's not perfect. The flaw in Warren Buffett's estate plan. So I don't know what that's all about. But the point that I'm making here is that I bet you that over the next several days, maybe several weeks, if this bear market continues, or if it becomes a bear market, you're going to see Warren Buffett making acquisitions. He's going to be making investments as other people are leaving, because he's going to see that as the opportunity to buy. So let's go. Let's finish up the story with this young lady. So now she's out of school. She got her first job. Her father says, max out your 401k, because she doesn't know better. She does what her dad told her. And she's investing right in the heart of the 2007, 2008 stock market crash. That's right when your cousin and them was telling you, oh, see, I told you it was stupid to invest in the stock market. The stock market is bad. That's crazy. Don't do that. Don't do that. You need to hold on to that money, right? I don't know if anybody else has relatives like that, but you have a lot of relatives that give you really bad financial advice. And it's weird to me that you would even listen to them, because most of those people are broke. Like, rule number one about getting financial advice and information is you probably shouldn't take that information from people who have no money at all. That's just probably just not a good protocol. Like you don't take weight loss advice from a person who's 450 pounds. No disrespect to anybody who's overweight. I'm one of them, but like I'm not the guy that's going to tell you how to eat perfectly healthy and how to lose 100 pounds, because I ain't never done it. Okay, so she does this. And so here's another piece. Here's another little piece, another little thing that took her off the stereotypical Negro path when it came to investing, where she went down her own, she went down the empowered Black woman path, is when she got her first place to live. Her father also said, buy a house as soon as you can, right? She didn't know really much about, the right time to buy and how to overthink it, or she didn't limit herself by saying, well, I don't know a whole lot about real estate, or she didn't say, well, I don't have enough extra money. Like, she just did it. She did what she was told. She went and bought a house instead of renting, right? So she bought the house at maybe 200,000. About 8 years later, the house is worth 450,000, or maybe it's $500,000, something like that. And so one day I just talked to her and I said, actually, I think you're a millionaire. You're either a millionaire, you're very close. And she's like, oh, come on, boys. I can't be a millionaire. What are you talking about? And I said, no, I think you're a millionaire. I'm adding in my head of what I think your assets are. And she said, yeah, but I'm not, I have a regular job. I don't make that much money. I can't be a millionaire. And I said, no, actually millionaire status means that if your assets minus your liabilities exceeds $1 million, then you're a millionaire, because your net worth exceeds $1 million. So I said, okay, how much is your house worth? She said about 500,000. And I said, okay, and that's mostly paid off, right? She said, yeah. And I said, okay. So I think let's say the house was paid off. I don't remember exactly what it was, something like that. And I said, well, how much is in your 401k now? She said, oh, it's a lot of money. It's about $700,000. And I said, oh, okay. So 700,000 plus 500,000. I said, you don't own any businesses or any other assets, right? She said, no, that's all. I don't own life. She said, I don't know anything about my money or finances. I said, yeah, but you got $1.2 million in assets. How much debt do you have? She said, about $20,000 in debt, and from school and something else, right? Or maybe it wasn't much. It wasn't much. And so when we subtracted her assets minus her liabilities, the number was over $1 million. I said, congratulations, you're a millionaire. And she was like, I never thought of myself as a millionaire. I mean, because I grew up poor. I grew up in the hood. And I said, yeah, a lot of people don't think of themselves as millionaires or having the ability to do it, because they think that somehow there's some magical thing that must happen when you're born for you to get a chance to have millionaire status. A lot of media convinces you that these things are possible for you to do. Now, I'm not sitting there trying to say everybody needs to be a millionaire to be content. That's not the point. The point I'm making to you is that it's not that hard to put yourself in a position of financial security, but the number one rule is that you cannot do what everybody else is doing, because most Americans are not financially secure. You have to get off the grid, and you have to spend a little bit different. You've got to invest a little bit different. You got to look at debt a little bit different. You got to look at education a little bit different, right? And so a lot of this really is about culture. And if you look at this example with this young woman I just described to you, who grew up poorer than probably anybody in this room. She didn't have a refrigerator. I bet most of y'all growing up, who in here did not have a refrigerator growing up? Anybody here is that poor? Yes or no? Did you have a refrigerator growing up? If you had a refrigerator, say yes. If you did not have a refrigerator, say no. So I can't imagine anybody in here being much poorer than she was. And she's a millionaire now. She became what David Bach refers to as the automatic millionaire. And these are thousands and thousands of people. They look just like you and I, who are no smarter than any of us, many of whom never went to business school, never studied investing, never even started a business, who are worth over $1 million because they made good, consistent, sound, solid financial decisions along the way. So I'm not here to really talk to you about how to get rich quick. I'm here to really talk to you more about how to get rich slowly. And one of the biggest things I can say to Black people who listen to me is you don't want to behave like the other Black people that are out here, being misled. No disrespect to those individuals. I hope that they come to listen eventually. But I already know that I'll never have as many people listening to me as there are who are listening to, Cardi B or their favorite basketball player or their favorite rapper or so. Like I'm never gonna have that, right? And that's okay with that. I want to rap to you, and what I want to rap to you is that there are opportunities for you and your family to put yourself in a strong, solid, long-term position, and I can show you how to do that. Okay, so let me answer a few more questions. And some of you said you couldn't see the link for the $1 trial for the stock market investing class. Well, here's the link. Give me a yes if you see the link in the chat. I'm putting it in there now. Type yes if you see the link, and no if you don't see the link. If you don't see the link, okay, I see. Let's see. Okay, I see a couple of no's. Okay, let me see. You know what? Here we go. Let me try it one more time here so you guys can see it. There we go. There's the link. There's the link. Okay. I just had to change something. So now I think, okay. So do you guys see it? Give me a yes or no if you see it. Okay. Okay, good. All right. So there's the link. All right. So let me go through some more of your questions real quick. Burrow says, is there a Black company that offers healthcare? I mean, I'm sure there are companies out there. I don't know what you mean. If you mean, healthcare insurance or just healthcare in general or healthcare, consultants or whatever the case may be. But there are plenty of Black companies out there that do that. If anybody knows of a company, please feel free to put it in the chat. Let's see, Natina, how do you purchase stock? Well, the simple answer is, apps like Acorn Stash and Robinhood, and also Cash App allow you to buy stock. The better response is you can feel free to check out the stock market class. There's a whole procedure. There's a whole breakdown of not just how you buy stock, but how you can shift your portfolio and do a lot of things. Also, what it means when your stock portfolio moves up and down, how that works. There's a lot of interesting dynamics there that can help you shape your investing strategy to fit your preference. So, for example, right now, a lot of people have leaned towards stocks that pay dividends because dividends are a little bit more reliable than capital gains. And I can't go into all of that right now because that's a deeper conversation. I break that down in the class. But basically, there are some moves you can make to find the portfolio that fits for you. Okay, so Joe says he doesn't see it. So give me a yes or no if you see it in the chat. Let's see. I see Joe says he doesn't see it. So I'm going to try to reply directly to you, Joe. Let me see. Okay, sorry, Joe. I can't. I think I lost your comment. Yeah, I lost Joe. So Dual, if you see Joe, share the link with Joe if you could, because I can't see where Joe went to. Malika says, or Malachi Velasquez. I always hear financial news talk shows talk about tech stock values being inflated, like those that are actually made no money but came to the market at $70 a share. What is that? They're inflated because basically tech stocks are. Remember, I was telling you that the types of things that the market reacts to are things that they know, things they don't know, and things they don't know they don't know. So a lot of stocks get their valuation from hopes and dreams of that this company is going to take off, like the possibilities of what this company could do, and they don't want to miss out on that. So what tends to happen in an environment where there's low fear, like the one we had before this crash, a lot of the reason this crash is so big is because the market was so inflated, the first time around. So ultimately, this type of reaction to the virus, I believe, probably wouldn't be as great as it is. A lot of stocks. Sorry, valuation from Sorry about that, guys. I gotta mute myself. A lot of the movement that you saw was driven by the fact that the market had been cruising up so high in the first place. So they say that the bigger they are, the harder they fall. Stuff like that. It's that's kind of what you're seeing, I think, here as well, is that because the market had been doing so well in the past, you're just seeing a pretty substantial correction, not just for the fundamentals of what's going on with the market, but also you're seeing a correction that's partly driven by the fact that people are looking at certain assets and saying, okay, these stocks were overvalued to begin with. They cost too much, from the jump. And so, and by the way, Dual, I put the actual long link in there. Share that long link if you can. I see you're putting BoyceWatkins.com. That's and the stock or the blackstockmarketprogram.com. Use that longer link because there's the discount code that has to be embedded. So that's the link you should use to get the dollar trial. All right, so let's see here. Does the stock market program teach swing and day trading and shorting? No, we don't talk about day trading. That's kind of beyond the scope of the program. I talk about it in kind of a general sense, but I don't really ethically feel good encouraging you to day trade because day trading is a whole different ballgame. I'm a believer in diversification and long-term investing as the key to invest, or the keys to building wealth. Let's see. Burl Toller says, thank you, Dr. Boyce. After hearing you teach and consistently invest in stocks 3 years ago with Stash and Robinhood, I have over 20K right now. I won't stop now. Keep teaching this message. Good for you. Good for you. And I like that because, you're really doing something special for your family by creating an environment of financial security, where you can actually focus on being a family and not have everything kind of disrupted because you've got these economic shocks. The number one cause of divorce is finances. Alicia and I talk about that all the time. And because she's actually a therapist and she gets, counseling to couples and families and children. And she says, oh yeah, finance is usually the biggest thing people argue about. So by sort of putting yourself in a good position financially, you are able to kind of avoid some of the issues that a lot of people have to deal with. Let's see here. William says he had no electricity and no refrigerator. Wow. Well, I'm glad you're here, brother. I'm very proud of you. Floyd Harris, mutual funds, annuities, stocks. Now, what's your opinion? I like them all. I invest in them all. That's what I'll say. I'm a big diversifier, so I can't pick one over the other. Sir, let's see. Derek says, sir, your thoughts on investing in funds that replicate the bellwethers of the NASDAQ and the NYSE. The benefit of index stock sorts of investments or indexes is that it allows you to have, what you can call instant diversification. Instant diversification means that you're able to sort of buy one asset and get the effects of owning multiple assets, and that's a pretty good thing. So yeah, I think indexes are a great way to go. I'm not telling you to do it, but I will say that it's that there are a lot of people who believe strongly in the uses of indexes and index funds and things like that. Let's see here. I'm over 50 and I want to know what are the benefits for me to start investing? Well, because number one, 50 isn't the same as 90. And number two, once you die, there are going to be people left behind. And so I would assume that you care about those people. So remember, investing is a team sport. Wealth building is a team sport. Most families that have significant amounts of wealth have that wealth because they have that wealth because of what somebody before them did for them. So you need to be that somebody for the people that you love. If you care about them, then you'll go ahead and plant a seed to put them in a position that will allow them to be successful. And so let's see. Ernestina says, perhaps I want to get your link because I'm in the UK. You should be able to get the link. Can you guys see the link for the $1 trial for the stock market class? And also, if you can't find the link, if for whatever reason, I'm gonna put the link back in here again. And if for whatever reason you can't find it, and Dual, if you could, I just shared the link again. If you could share that link, the code you can use, if you go to theblackstockmarketprogram.com, that's theblackstockmarketprogram.com, you can go there and that should work. Or you can also use the code $1 stock market and it'll give you the dollar trial. So either one of those would work. And I'm gonna go ahead and share the link with you guys one more time. And I hope you guys will consider trying out the class. If you don't like it for any reason, you can always get your money back. We give 30-day, 100% money back guarantees in the Black Business School because we want to make your life better. And we're not asking you for your money. We want you to invest in yourselves, and we want you to do it not for us. We want you to do it for yourself. And if you don't feel like it benefits you, then you should tell us, and we can go and make an adjustment for you. We want to make you happy. That's very important to us. But we also want to build a university for Black people that are going to teach Black people the things that Black people need to know in a way that Black people can relate to, that allow us to benefit and grow. Remember, I taught at Syracuse University for 13 years, and you see right now in the media, Syracuse is in the news for the way they're treating their Black students. I personally believe that it is sinful for us to go give $70,000 a year to a university that does not respect Black people. When you've got great institutions like the Black Business School that have real business owners like billionaire Mike Roberts, who's come through. We have attorney Nicole Compton, Julian Gordon, who went to Stanford University, is extraordinarily good at real estate. We have extraordinary people that have come through the Black Business School who are far better than the faculty at a place like a Syracuse University. And so what I just encourage you to consider is that, perhaps it's a little bit of a contradiction that we would go spend $70,000 to learn from inferior people who don't respect Black people. And we kind of balk at spending $3 a day or whatever, or $100 a month or whatever it is, to learn from Black people who love you, who are really there for you, who understand you, and who can elevate you, right? So I'm not telling you to love us just because we're Black. I'm telling you to give us a shot because we've proven ourselves. You guys have seen me up here. I've probably done 10,000 videos or something, 5,000 videos. It's in the thousands. And I would dare you to go find anybody at a Syracuse University who's even done one video like this for the Black community, expressing and answering questions and sharing things the way we share things now. So that's my appeal for the Black Business School. We even have our own apparel. We have a lot of things in place, and our vision, our long-term vision, is that we believe in what we call the Black Core of Three. Black people should educate our own children, create our own jobs, and support Black businesses. So we're trying to build an institution that's going to be around for the next 400 years. And we don't believe it's going to be superior to what's out there. We know that it already is. So feel free to try out that link, and you can get a 30 days for just $1. We'd love to have you in the stock market class. We have meetings like this all the time. We'll continue to have more, and I'll continue to update you guys on the coronavirus. And so there's the link one more time. So feel free to go check it out. And thank you guys for listening. It was a lot of fun, and I hope you guys benefited from the conversation. So take care, guys. Love you, and I will see you soon. Be good.